students to the massive open online course in money and financial markets. In today's module, we are going to learn about the various measures of money supply with special reference to the Indian economy. The basic objectives in this module would be as follows. This module will be focusing on the importance of the concept of money supply in an economy. It will delve into the various working groups of the Reserve Bank of India who were concerned in constructing the various money supply measures. We would also define clearly all the money supply measures along with the new monetary aggregates and the liquidity aggregates. In an economy, we all know that the key macroeconomic variables like income, prices, wages, rates of interest, and balance of payments, they play an integral part in an economy and its development. We all know that the key macroeconomic variables in an economy are income, prices, wages, rates of interest, and balance of payments. These key macroeconomic variables play an integral part in an economy and its development. This makes it imperative that the concept of money supply is properly understood and its measurement is also done appropriately. Now, there are theories which stress on the transactions motive of holding money, and they generally favor a narrow measure, while there are theories that treat money as an asset for store of value, emphasizing on a broader measure of money. The different financial and real assets could be arranged in a descending order with reference to their liquidity. Currency and demand deposits are the most liquid assets as they are considered as a medium of exchange. There are several measures of money for which we can say that they are quite liquid assets, but each of them are successively dropping a point lower on the liquidity scale in differentiating between money and all other assets. So we can say that basically there is no unique definition of what money is. So for policy purposes, it could be defined as the set of liquid financial assets, the variations in the stock of which could have an impact on the aggregate economic activity. So, if we come to the definition of money supply, it is basically defined as the total quantity of money circulating in the economy. It can be in cash or it can be in the form of liquid assets at any particular point of time. One important point that should be noted in this context is that the stock of money that is kept with the government, with the central bank, that is the Reserve Bank of India, is not taken into account in the calculation of measures of money supply. Because this money is actually not in circulation in the economy and hence they do not form a part of monetary supply. So money supply offers an insight into the liquidity of the system, and liquidity here is defined as the ability to quickly and easily convert an asset to cash. Money, when we talk about money which are held by the public, it means money that are kept by all the individuals in the economy, the firms within the country. And as I have already said before, money held by the government and the banks, they are not considered in the calculation of the measures of money supply. So we can say that measures of the money supply is the method of calculation of all the money held by individuals and firms in the country. Now, basically, when we look at the evolution of money supply measures in the context of the Indian economy, the Central Bank of India, that is the Reserve Bank of India, had constituted three working groups while constructing the various money supply measures. The first working group of the Reserve Bank of India was operational from 1961 to 1967-68. The second working group of the Reserve Bank of India was operational from 1977 to 1998, while the third working group, which was the most important one, came into being in 1998. Now, if we look into the recommendations that were made by the first working group of the Reserve Bank of India, which was operational from 1961 to 1967-68, we find that at that point of time, there was only a single measure of money supply, okay? And that consisted of only a narrow definition of money. It basically included the public holdings of free currency and also the demand deposits. So as you can see in the slide, M here denotes the money supply, while C denotes the currency that is there in circulation in the economy, and DD basically emphasizes on the demand deposits. So here we find that the money supply measure, as pioneered by the first working group of the RBI, emphasized the role of money as a liquid asset as well as a medium of exchange. So as we all know, currency, coins in circulation, they're all a liquid asset, and also they are also act as a medium of exchange. Now, from 1967-68 to April 1977, RBI started publishing aggregate monetary resources with the inclusion of another near money, which is basically the term deposits. So here again in the slide, as all of you can see, AMR, that is the aggregate monetary resources, is nothing but M, that is the money supply, plus the term deposits. And we already know that money supply is nothing but currency in circulation plus the demand deposits. So the aggregate monetary resources is nothing but currency in circulation plus the demand deposits plus the term deposits. Gradually we come to the second working group of the Reserve Bank of India, which was operational from 1977 to 1998. In the year 1977, the RBI introduced four components of money supply. The purpose of these four components was to measure the quantity and the variation of the money supply. And these components were M1, M2, M3, and M4. So, in very simple words, if we have to measure the amount of money in circulation in the economy, then we have to determine these four components as given by the RBI, and then we need to add all of them together. So here we have, according to the second working group, we have the measures of money supply as M1 plus M2 plus M3 plus M4. So now we are going to analyze each one of these measures of money supply and find out what constitutes them. As I was telling earlier, that the total money supply measure or the monetary aggregates was basically equal to M1 plus M2 plus M3 plus M4. Now, if we look at the definitions of these closely, we find that M1 is nothing but the total currency in circulation with the public plus the demand deposits plus other deposits with the RBI. M2 is equal to M1 plus savings deposits with the post office savings bank. M3 is equal to M2 plus time deposits, while M4 is equal to M3 plus all the deposits with post office savings organizations. So we can say that the second working group of the RBI ranked assets in varying or rather decreasing degree of liquidity. Now, there was an extended institutional coverage of post offices and cooperative banks, which by then had started a wide network to supplement the commercial banks in their deposit and credit coverage, particularly after the banks were nationalized in the Indian economy. Now, if we look closely at the definition of M1, as I said, M1 basically implies the currency in circulation plus demand deposits plus other deposits. What do we mean by currency in circulation? It basically includes all the money, notes, coins, currencies that were issued by the Reserve Bank of India. And we all know that the 1 rupee note or coin is not issued by the RBI. It is basically issued by the government of India. So it also includes the 1 rupee notes that are issued by the government. So, in the process of determining the amount of money which is in circulation in the country, we have to start with the most basic form of money which we use on a day-to-day basis. That is a currency and coins in circulation. Now, next we have in the definition of M1 is the demand deposits. Now, the money which we deposit in banks, only commercial banks, mind it, only commercial banks are called demand deposits. It is also included in M1 because the money that we deposit in the banks is also in circulation. We can withdraw it whenever we want as per our convenience and usage. While the deposit of both the current and the savings accounts are also included in the demand deposits. But this point should be noted very closely that interbank deposits are not included in demand deposits. The last component that we have in the definition of M1 is other deposit. The other deposit includes deposits made by the foreign central banks or any organization like the World Bank or the World Health Organization in the Reserve Bank of India, and this comes in the category of other deposits. But it should be again kept in mind that any deposits made by the government of India with the RBI is not included under the other deposits. So according to the definition, M1 is also known as narrow money because it includes only those 100% liquid deposits, which is a very, very narrow definition of the money supply. We come to the second definition of money supply, that is M2. Now, what is M2? M2 includes everything that we had in M1, plus here we make an additional measure. We are going to measure here also the demand deposits with the post offices. I come back with the answer to the question that I've asked before. Now, we see that the demand deposit with the post offices is less liquid in comparison with the banks. Now, here what do we mean by liquidity? Liquidity basically means the ease of encashing. So, the deposit of a post office is a bit slow to encash as compared to the commercial banks. So, we can say that post office transactions are less liquid because we cannot withdraw the deposit with the help of check from a post office. Hence, it cannot be called 100% liquid, and so we do not include it in M1, and we use another different measure, that is M2, to include the post office deposits. Next, we come to our third definition, that is M3. So what is M3? M3 includes everything that was there in M1 plus the post office savings deposits that was included in M2, and here we add another additional deposit which we call time deposit with the commercial banks. Now this third component, that is M3, is called the broad money. So there we had M1, that is a narrow money, And here we have M3, which is called the broad money. So as I have already said, M3 is M1 plus M2 plus time deposit with the commercial banks. Here, as all of you can see, I have introduced another new terminology, time deposit. What are time deposits? Now, all the fixed deposits that we have, the recurring deposits, the people that have opened all these deposits in banks, all these deposits are called time deposits. Now, we all know that whenever we do fixed deposits, we mention a certain period of time. While we do a recurring deposit also, we also mention a certain period of time. So all these deposits that people make in banks, the fixed deposits, the recurring deposits, they all come under the ambit of time deposits. Okay? So time deposits consists of a major part of our deposit in our country. Now, of course, M3 is also much less liquid in terms of M1 and M2. Okay, they're much less liquid. Because whenever someone wants to withdraw money before maturity, what does the bank do? The bank generally penalizes some amount from the sum. So obviously it is less liquid as compared to M1 and M2. In M3, only that money is included which are deposited in commercial banks and not in post offices. Please keep this in mind. In M3, only the time deposit of commercial banks are taken into consideration. We next come to the definition of M4. Now, M4 basically implies M3, mind it, not M1 plus M2. It is M3 plus time deposit with post offices. So as you see, in M3, we did not include the time deposit with post offices. We had only the time deposit with the commercial banks. But now here in M4, we add M3 along with the time deposit with post offices. So M4 is the least liquid form of money. Now, as we know that post office banks also accepts fixed deposit, that is time deposit. So M4 is calculated by adding M3 with the time deposit of post offices. It should be noted that amongst all these four measures of money supply or the components, M3 is the most important indicator for the RBI to analyze the quantity and variation of the money supply because it includes most of the money in circulation. Now here we come to the final working group of RBI, which was formed in 1998. So the existing monetary aggregates, that is from M1 to M4, they were revisited by the working group on money supply, the analytics and methodology of compilation in 1998. The chairman of that working group was Y.V. Reddy. Now, this was because during the financial liberalization, banks were resorting to non-traditional sources of funds under increasing competitive pressures. So, under this situation or circumstances, financial institutions had also started operating differently. And so, by then, the definitions of M1, M2, M3, M4 were not very much appropriate to the pressing needs of the financial times. Here, before we go into the recommendations of the third working group, let us see how it really worked. Basically, the third working group divided the economy into 5 sectors, consisting of households, non-financial commercial sector, the general government, financial corporations comprising of the banking sector, which obviously consisted of the central bank, the RBI, and the total banking system in India. And we had the other financial corporation sector. And then we had the fifth one, that is the rest of the world sector. So basically, the whole economy was divided into 5 sectors while measuring or forming the monetary aggregates by the third working group. If we try to compare this with the first and the second working group of the RBI, we find that both the first and the second working group had divided the economy into only 3 sectors. They were, number 1, private or commercial sector, which was subdivided into A, rest of the domestic sector, including public non-government sector undertakings, and B, the foreign sectors. Then the second sector was the banking sector, and the third sector was the government sector. Okay, so we see that while the economy was divided into 5 categories by the third working group, the first and the second working group dealt with the economy with using only 3 sectors. And another very important terminology was introduced in by the third working committee. It is the residency issue. Residency relates to the country in which the holder has a center of economic interest. The non-resident Indians, or the NRIs, they hold their deposits in India in basically 2 forms. One is NRI rupee deposits, and the second is NRI repatriable foreign currency deposits. Now, if the currency and the demand deposits which are held by the NRIs are repatriable, like the FCNRB and the Resurgent India bonds deposits, they would have more relevance for the balance of payments and the international capital flows than the domestic transactions. Therefore, these should be regarded as external liabilities to be netted out from the foreign currency assets of the banking system. So, the foreign currency liabilities of banks have now been identified explicitly in the new aggregate measures that I'm going to relate after this, enabling an accurate compilation of banks' net foreign assets. Here, before I go into 2 concepts I'm going to introduce now. Basically, it was introduced by the third working committee. One is monetary aggregates and the other is liquidity aggregates. Now, this differentiation that was done by the third working group of financial aggregates was between these 2 categories, the monetary aggregates and the liquidity aggregates. And this differentiation was not made on the basis of the attributes of the instruments themselves, but rather on the nature and the functions of institutions issuing such instruments. If we look at the monetary aggregates, we find that the monetary aggregates considers only the liabilities of the depository corporations, which includes following institutions which can make deposits, like the RBI, the banking systems consisting of obviously SBI, the State Bank of India and its subsidiaries, all the nationalized banks, the regional rural banks, the commercial banks in the private sector, like we have the HDFC and the Axis banks and the ICICI banks and various other foreign banks, and the 5th are the cooperative banks. However, as the economy has progressed over time, we find that the share of non-depository corporations in the total financial assets has been growing steadily. Therefore, when we look at the broader concept of liquidity, we find that the total assets that are held by the public, that are issued by all financial intermediaries, both banks as well as the non-banks, they should also be included. So, when we talk about the new monetary aggregates, we can define them based on the nature and functioning of the institutions who are issuing such instruments. We have the first measure as NM0, the new monetary aggregate 0. This is nothing but it is essentially the monetary base which is compiled mainly from the balance sheet of the RBI. Now, NM0 is what? New monetary aggregate 0. It is nothing but the monetary base, which is again nothing but the currency in circulation plus the bankers' deposits with the RBI plus other deposits with the RBI. Next, we have NM1, the new monetary aggregate 1. It purely reflects the non-interest bearing monetary liabilities of the banking sector. So, NM1 is equal to currency with the public plus demand deposits with the banking system, which includes both the current deposits as well as the demand liabilities portion of the savings deposits plus other deposits with the RBI. Next, we have NM2 or the new monetary aggregate 2. It includes, besides all the currency and the current deposits, it also includes the savings and the short-term deposits, reflecting transactions balances of entities. Now, NM2 is what? NM2 is equal to NM1 plus all the short-term time deposits of the residents, including an up to contractual maturity of 1 year, plus time liability portion of the savings deposits, plus certificate of deposits. And finally, we have NM3, that is a new monetary aggregate 3, which is NM2 plus long-term time deposits of residents, that is contractual maturity over 1 year, plus call or term funding from financial institutions and call borrowings from non-depository financial corporations. Now, these new monetary aggregates comes with certain features. The NM1, NM2 and NM3, they're used to distinguish the new monetary aggregates from the existing monetary aggregates. The existing monetary aggregates are M1, M2, M3 and M4. Now, NM2 and NM3 are based on the residency concept which I had explained in some previous slide. And hence, they do not directly consider the non-resident foreign currency repatriable fixed deposits. Residency essentially relates to the country in which the holder has a center of economic interest. Now, only non-resident repatriable foreign currency fixed deposits are excluded from the demand liabilities and treated as external liabilities. So, non-resident rupee-denominated deposits have been retained as a part of deposit and monetary aggregates. Next, we have, as I have already said before, we have a separate distinction between the new monetary aggregates, and there's a new term that has come up. It is called new liquidity aggregate. We find that after deregulation, since the share of non-depository corporations has been increasing, so therefore liquidity aggregates were introduced so as to provide a broader magnitude of monetary and near money liabilities which were issued by the non-banking financial institutions. Postal deposits, they have been excluded from the monetary aggregate. In all the NM0, NM1, NM2 that I have been saying before, I have nowhere have I included post office, the postal deposits. They have been basically excluded from the monetary aggregates, and they are now a part of the liquidity aggregate. Now, this was to keep the differentiation criterion intact. Also, the deposit liabilities of financial institutions were made a part of broader liquidity aggregate. So, liquidity aggregates are L1, which is NM3 that has been defined before, plus all the deposits with the post office savings bank, excluding obviously the NSCs, the National Savings Certificates. While L2 was L1 plus term deposits with term lending institutions and refinancing institutions, the FIs, plus term borrowings by the FIs, plus certificates of deposits issued by these financial institutions. So, in concluding this module, we come to the following conclusion. Number 1, there is no unique definition of money. Number 2, the money supply refers to its stock held at a particular point of time by the public. 3, the demanders of money are separated from the suppliers of money. And 4, the third working group committee of the RBI have separated the monetary aggregates and the liquidity aggregates. And these really reflect the changes in our country's financial system.